I'm Wynston Mackie. I'm the financial advisor on the Connecta Wealth Management team. I cover 3 branches with Connecta, the El Segundo branch on El Segundo Boulevard, the Westchester branch, and then also the Santa Monica branch on Wilshire Boulevard. As part of our ongoing webinar series with the Connecta Wealth Management team, I want to say we are very honored to have Chad Balcom here today to help us out. Chad is the regional director with Russell Investments. Russell Investments is one of our very valued partners here at Connecta Wealth Management. They provide a lot of very great, unique investment solutions for our members. I've been helping our members out for a very long time. And today, Chad is here to give us a very positive message about the economy, the stock market, and our outlook for the year. And then also, this is giving you direct access to one of our very valued partners and resources that helps us prepare for our members year in and year out as we approach the stock market, investing, and helping our members grow their assets here on the wealth management side. First thing, just a little bit of housekeeping. If you can hold your questions till the end of the presentation, please. If you can't remember, just jot it down. You can also put it in the chat box, but we'll get back to it at the end of the presentation. Let's see, what else we got here? Oh, Chad and I will keep this very short and sweet. So Chad was going to give us about 30 minutes of a lot of great information. Again, this is very positive. We did this, Chad and I did this about 1.5 years ago. The market was not as good. The message was a little different. But this is really just to let you know, no matter what market we approach, here at Connecta Wealth Management, we're always staying very prepared. We're utilizing our intelligence that we have out here in the industry, and we're always trying to get prepared for what the future holds for us and our members. So with that said, I'd like to pass it on to Chad. Again, this is direct access to our knowledge and expertise, some of the resources we have here. And I look forward to it just as much as I hope you do, hearing this positive message about the economy, the stock market in 2024. There you go, Chad.
All right, great. Thanks, Wynston. Appreciate that very warm intro. Just want to do an audible. You can hear me okay and see the screen okay, correct?
Yes.
Okay, perfect. Well, as Wynston mentioned, Chad Balcom, I'm the regional director for Russell Investments. I actually live in West Hollywood, so I am your neighbor. I'm very delighted to be here, and I have to admit, although our firms are pretty well connected, in all humility, we're just one of the many investment solutions that Connecta Federal Credit Union has to select from. So I'm very honored to be here and appreciate everybody's time, especially at 4:38 on a Thursday evening when it's starting to be sunny now that we're through the bulk of the winter months. But I'll do my best to make a positive introduction to where we think the capital markets and the global economies are. We're going to talk about interest rates as well, as it sounds like that's on a lot of folks' minds. But really, we're going to just kind of provide an overview on the following topics, just to give you a general sense of what's going on. And of course, if you have any questions, there is a chat button at the bottom of your screen. You can just click that, submit your questions along the way, and I'll let Wynston facilitate that as we go, just to make sure that we get everything addressed and get you out on time this evening. Okay, so with that in view, let's just start with 2023 in review. If we go all the way back to January of last year, so 13 months ago, remember, that was just off the heels of 2022, where we saw the S&P 500 down about 18%. So it was a rough year. The Fed was trying to slow down the economy. That was the year that we saw inflation peak up to about 9%. And the Fed, in response, started raising interest rates to slow down the economy, which made it a very difficult year. Last year, though, if you look at how we progressed throughout the year, there was a bit of volatility, as you can see. And the dark purple line is the S&P 500. The lighter purple line is just what we call the Barclays Aggregate Bond Index, so just the health of the overall bond market within the United States. And you can see it started in January, February, and March. We saw a little bit of volatility, but then by the end of the year, gosh, if you held on, you had 26% more money than what you started with in equities, and about 5% more than what you started with fixed income. So a little bit of patience fared out really well for a lot of investors. But I just want to remind us all the things that we went through last year, all the major headlines around the perimeter of the slide. And this is pretty indicative of what we'd experience pretty much every year. We always have headline risk to contend with, not only in the United States, but abroad as well. And of course, that does impact the markets both positively and, unfortunately, as we saw in 2022, negatively as well. But for investors that stay the course and play the long-term averages, the capital markets do, in fact, reward you for your patience, especially given your time horizon. So just affirmation that although last year was a bit of an interesting year, especially at the beginning, we definitely ended up in positive territory across the board, which was a nice departure from what we saw the year prior. Now, we are obviously in an election year. We're going to talk about that a little bit just for context. However, I want to start with where the economy is in general right now. And keep in mind, the economy kind of operates on a bit of a different cycle and a different framework than the markets. You can have a great economy and a bad market, and a good market and a bad economy. But to put in context where we're at today, really what you're looking at here, this is what we call the economic indicators dashboard. And it works just like the dashboard on your car, where, you know, when you turn the key, you'll see red lights and amber lights flashing that indicate there might be something wrong with the vehicle. The dashboard here, from the economic standpoint, works basically the same. So the little orange flags, those are the current measurements based on where we're currently at for each of the indicators listed kind of in the middle left. The blue bar represents where the numbers would normally fall about 2/3 of the time if we pick a random date in history. And then the numbers in each indicator on the far left and right, those are just the extremes that we've seen since each of those indicators were first tracked. Now, just starting with market volatility at the top, you can see a measurement of about 12. That's just indicating the kind of volatility that we're going to be seeing here, or at least what the market is anticipating in the next 60 days. And you can see, actually, we haven't really seen a whole lot of market volatility, or at least implied volatility in our market. We're not only at the low end historically, but we're also in the low end in terms of what we would normally see on any given date as well. Now, contrast that to the number all the way to the far right, that's 62.64. That's the kind of volatility that we were seeing in the global financial crisis, for a reference point. So we're nowhere near that level. Things are pretty calm. Of course, the markets are going to move around a little bit day to day, but we're not seeing near the kind of volatility that we saw during the global financial crisis. We've calmed down quite a bit. And that's kind of interesting. We've got a lot of global conflicts, certainly Israel and Hamas. You've got Russia and Ukraine. Obviously, China has had some fits and starts, given what's going on over there as well. So by and large, though, the markets have been pretty serene. And I think that's just kind of an interesting comment that perhaps a lot of the stuff that we're seeing is already priced into the market. If we skip down to home prices, I think that's an interesting statistic as well, because as Americans, when we have equity in our home, we like to spend it. We like to pay down more expensive debt elsewhere. We like to put kids through college or buy a car. So the fact that home prices are increasing on a year-over-year rate of about 4.8% is a really positive number. Consumers, we spend that. We will also remodel. We'll buy hammers and paint and nails and things like that to fix up our home. So the fact that we do have increased home prices is great. Now, the other side of that, though, is if you're trying to buy a home, the home is just simply 5% roughly more expensive than it was this time last year. So on the buying side, it does create some friction. You have to allocate or budget a little bit differently in order to afford it. But by and large, a little bit of extra equity in your home is definitely a positive thing for the U.S. economy. Now, inflation. Well, again, we noted a couple of years ago, the Fed was very concerned because we hit a 40-year peak of about 9% on inflation. And of course, that number has really come down since that peak a couple of years ago. In fact, actually, it's moved up a little bit from the time of when we ran this particular slide deck. But right now, we're at about 3.25 as indicated here. And the trend over the last 3 months is that we've been trending down. Now, that in an election year this year is probably one of the most important numbers to look at, because the Fed's target for inflation is 2%. So we're clearly above that target. And unfortunately, what makes it a little bit more challenging from the Fed's perspective is that we have really low unemployment. And I know that seems kind of like an oxymoron, but from a market perspective, if you have a lot of people that are employed and gainfully so, that's great. We tend to spend income, or at least we spend on anticipated income. And so that's definitely a positive for our economy. But think of it from the Fed's perspective. If you have inflation that's a little higher than what you're anticipating, and you just have a lot more people participating in the economy, and folks that now have a little bit higher wage, meaning they have a little more disposable income to spend. That just puts a little more pressure on the inflation number from the Fed's perspective. So right now, our current expectation is we just simply think the Fed is going to hold interest rates a little higher for longer to see what other impacts are made on the inflation number before we see any changes there. We're going to come back to that in different terms here in a little bit, but just wanted to give you a reference point in all the news headlines that you might be paying attention outside of maybe what's discussed from a political spectrum. The Fed is probably one of the more important headlines right now, and their comments on inflation and unemployment would give a lot of information in terms of what we might expect from an economic perspective. So just something to watch out there specifically. Economic expansion, or GDP, gosh, let's face it, we've had some really good numbers from a GDP perspective. Now, this number has also calmed down a little bit since the running of this report, which was December 31st. But even so, it's still within positive territory. And all this means is that our economy is growing at a really healthy clip. So we're very happy about that. Consumer sentiment, again, at the time of this running, it was a measurement about 70%. That's actually gone above that and now is well within the typical range as well. So that's also a positive, because if we're feeling good about the economy and job prospects, if you have kids, hopefully it's a little easier for them to find work in the economy. All of that's great. It means we just have more confidence, and then we spend accordingly as well. So by and large, although there might be some areas in the economy, largely on the national level, that would be watch points for us, things for the most part are pretty positive. And it's helpful to put those numbers in context so you can see where we fit relative to historic norms. Okay, we're going to skip down a little bit, and I just want to focus on one area of the U.S. market that's getting a lot of attention, which is, I'm sure many of you have heard the term Magnificent Seven. That's just focused largely on the 7 names that you're seeing here on the top half of the slide deck. I would like to focus on Tesla specifically, if I may. And what you're looking at, you've got a dark purple, a lighter shade of purple, and then a gray bar. Those are just indicating 3 different windows of Tesla's performance over the last 2 years. So you've got 2022 indicated in dark purple, and that year Tesla stock went down 65%. So think of it this way. If you'd invested $100 in Tesla at the beginning of 2022, by the end of the year, it was down 65%. So you only had $35 left. Now, if you held on to that stock, you can see in 2023 it doubled. It was up 100%, so you doubled your money from $35. But doubling from 35 only gets you to 70, which means for the 2-year period combined, you're still down about 30%. Remember, you invested $100 at the beginning, and even though you had great performance last year, it wasn't enough to bring you up to your original dollar. So what this is telling us is that although tech is driving a lot of the market, if we take a little bit longer time horizon overall, we're not really seeing quite the performance that you might have come to expect. In fact, look at the S&P 500 on the far right. In 2022, the market again was down about 18%. Last year, you got a 26% rate of return, so you benefited greatly. But the 2 years combined, you only are getting about 3% return. And this is a little bit of a concern by a lot of our managers at Russell Investments, because it just simply means you got a little bit more volatility in these names without perhaps the larger return that the news has been quoting just over the last year alone. Doesn't mean it's bad. It just means maybe there's a little bit more risk in the portfolio, especially because, as you can see down below, these 7 names alone out of the S&P 500. So remember, the S&P 500 is 500 stocks that get tracked within the index, but just 7 names make up 30% of the direction of that index. So these names are really having a lot of impact on the direction of our markets. Again, not necessarily bad, just means that perhaps they might be getting a little bit expensive by our estimation, and that's when we like to diversify the portfolio. Now, outside of that, if we look at international stocks, I know international, by many measures, has not performed quite as well as the United States has over the last 13 years alone. But what's really interesting is that, as you can see on the left-hand side, non-U.S. stocks are just a little bit less expensive. In fact, 30% less expensive than stocks in the United States. Also, as you can see on the right, they're yielding 2% more. So if you think about dividends from those companies abroad, they're just providing a higher dividend yield, about 2% more, above and away what the U.S. market is already providing. So what this slide is telling us is that the cheaper, and they're yielding a little bit more. I think what's really interesting, though, is, again, non-U.S. has not been quite as strong of a performer as the United States, but think about the way in which investors look at their portfolios. Although past performance is important and it's helpful and obviously something we want to look at, what really is important is where the markets are headed next. And if we've got an area of the market that's really on sale, we've got some good numbers being racked up, there's good dividend yield, it just kind of indicates that maybe that's an area of the globe that we should take a look at outside the United States. Now, just to add on to this, one thing that I like to make mention of is think about the brands that we're actually talking about. So if we look at some companies that we participate with in the United States, you might not actually have them represented in your portfolio, and these are brands that you might know and really love. So think about Ray-Ban or Sunglass Hut. That's actually an Italian brand. Those companies are domiciled in Italy. If you think about Firestone or 7-Eleven, those are Japanese companies. If you think about Accenture, that's Irish. Let's see, Forbes is a Chinese company. Even Trader Joe's here is a German company. So again, these are companies that you probably know and love and visit often, or at least log into the websites in some instances. But from an investment standpoint, because they're non-US brands, sometimes they can be outside of your investment portfolio. So it just might be a reminder to take a look at how you're allocated. Certainly the folks at Connective Federal Credit Union, including Wynston, can help you with that. But this might be an important part and a clue in terms of where markets might be headed going forward. Now, from an interest rate perspective, just revisiting the US bond market again, you can see there's a couple of circles here in the middle of the screen. If you just please look at the December 23rd number, kind of in the middle right. Currently, the bond market is yielding about 4.5%. Now, as bond math goes, if you buy a bond today that's yielding 5% and you hold it all the way to maturity, you get your money back plus that 5% coupon that's been paid out as part of the guarantee of that portfolio. Now, unfortunately, fixed income, or I should say interest rates, don't stay static for long. They tend to move around quite a bit, especially as the Fed is trying to respond to inflation. So again, our current expectation is that the Fed will just simply leave rates higher for longer, which means you're going to get the current yield in your portfolio, and the broad market again is 4.5%. So you fast forward 12 months, you get your money back plus that 4.5%. However, if we do go into a recession, or the Fed just simply decides, okay, it seems like the economy is on a better footing, we don't have to worry about inflation, we can start to ease interest rates, and they start to lower interest rates. What happens in response is that the bond market has to start repricing bonds that have already been issued at that higher rate so that they're selling at the overarching rate at that time. So in other words, as rates go down, bond prices go up. And you can see the arrow that's pointing to the lower right-hand side of the screen. What that's telling us is if you fast forward again on that same fixed income portfolio, you're still going to get the yield of 4.5%. But because the market is having to reprice those bonds to keep up with the current rate in reflection of the Fed, prices increase. So you get the 4.5% yield, but now you also get an additional 6.2% based on the prices as they're adjusting along the way. So this should be really positive news for fixed income investors because already you're getting a higher yield anyway. But if the Fed does in fact reduce rates, you get a little bit of a price kicker at the same time in your fixed income portfolio. I know fixed income has been a little challenging, again, because 2 years ago the Fed was raising rates, and I just want to show you what a little bit of patience made in fixed income just last year alone. So if you look at the U.S. aggregate row here, it's kind of on the left-hand side, second row, you can see first quarter, second quarter, and third quarter as yields went up. In fact, it went up about 0.71%. Prices went down. So because rates went up, you lost a little bit on the price side of fixed income. However, if you waited to the end of fourth quarter, the Fed hadn't really done anything, but the market did decide that the Fed was starting to potentially ease its stance on inflation, meaning they were going to reduce rates, or at least that was the market's expectation. So even though the Fed didn't do anything, the market started to ease up on yields, and you can see it went down about less than 1%, so 0.86%, which means, again, that the prices adjusted to reflect that. So for the quarter, you got almost 7%, and for the year, as you can see on the right-hand side, you got 5.53% in return for the year. So fourth quarter was an incredibly lucrative quarter for fixed income. In fact, it was the best quarter for fixed income in 35 years. So for investors that stayed the course, they were handily rewarded for that, and we're seeing that trend continue already in the first half of this year as well. Okay, moving on. Let's just to focus on recessions. I think what's really interesting is in a recessionary period, or at least leading up to one, we oftentimes feel that the market is going to provide a bit of volatility, or at least we're going to see a loss in value on our account statement. But going back to 1926, if we look at a 60-40, or what we call a balanced investment portfolio, the data doesn't really hold up in that regard. In fact, actually, investors leading up to a recession, during a recession, and in the 3, 6, 9, and 12 months that followed the end of a recession, investors were actually pretty well rewarded, as you can see by the dark purple bars for each of those respective periods. So I think this is really interesting. You know, what really happens is that we oftentimes feel that a recession is going to provide the most maximum downside in our portfolio. But again, the reward is that oftentimes the market already prices that in and then moves forward anyway, and you're seeing that reward listed here on this slide. So just because we might be going into a recession doesn't necessarily mean that from an investment standpoint, you're always going to see a negative rate of return on your statement. In fact, quite the opposite. 60-40 or a balanced portfolio has typically provided a much better outcome even versus cash, which is kind of an interesting data point to reference. Long way of saying, by the way, if you have a financial plan, which includes moderate to severe instances of volatility, even stuff that's come from recessions, oftentimes the plan itself can be rewarding because it includes those instances of volatility, and sticking to it provides the better reward. Now, if we look at elections, I love this slide. This is one of my favorites in the whole deck, really, this quarter. Down below, what you're looking at are all the presidents going back to Roosevelt in the 30s, and you can see which party every president was affiliated with and the length of time that they were in the office. And what's really interesting, the first observation is that pretty much every president has to contend with a recession somewhere in their career. And the recessionary periods are indicated by the gray bars listed throughout this slide. So you can see they happen with a fair degree of regularity. Now, a lot of people just kind of move on from that point and say, well, look, you know, the markets can continue to go up anyway. But I think what's really interesting is that, one, recessionary periods don't really last as long as we typically feel that they might. You can see the gray bars. They just don't last a whole lot. Well, reference that versus the voids or the white spaces in between. Those are the periods in between recessions where you built wealth, assuming that you participated in the market. So I really like this slide because it shows that the recessionary periods are not very long, but the period in which you build wealth completely trumps those periods. Also, as an asset manager, you know, we don't want to lose value for our clients by maintaining an investment through recessionary periods. However, we really like when things go on sale. So what's interesting is as recessions sometimes can provide the kind of volatility and the market pullback in the immediate sense as far as the S&P 500 is concerned, that's an opportunity to buy stocks that we know and we love at just simply a cheaper price point, so that when we exit the recession, you have a little bit more growth in the portfolio. So I really like this slide for that reason. Just kind of highlights that staying the course does, in fact, provide investors a good outcome, but you've got to stay put to get it. Okay, now for those of you that received a 1099 from your investment portfolio, this might be an important slide for you. I'm actually going to grab my pen and hopefully you can see the edits I'm going to make here. But if we look at 2023 alone, capital gain distributions by the mutual fund industry averaged about 5% within U.S. equity products alone. The dividend yield on the U.S. stock market was about 1.5%, and interest income was about 4.5%. So that's what you received on fixed income. Now, if we apply those rates to a $1 million portfolio that's split between stocks and bonds, this is the amount that you'd see on your 1099. Now, that's the document you're going to hand to the CPA if you haven't already. Your CPA is going to say, okay, here are the applicable tax rates for your individual situation. And unfortunately, your CPA is going to tell you, and by the way, you now owe $17,000 to the IRS. So this is a really important perspective because there are investment solutions that help limit the amount of capital gain distributions and also look at different areas of interest income. Think of munis that would be tax exempt from a federal perspective. Now, if this is something that applies to you, I definitely would encourage you to call Wynston and the folks at Connective Federal Credit Union so that you can figure out a little bit more about how this might apply to your specific situation. But I think this is really important for a couple of reasons in general. The first is that the Tax Cut and Jobs Act is set to expire in 2025. That effectively, for some Americans, is a tax rate increase. We've also been talking about the government shutdown. Again, that's the fourth time in the last 18 months that we've been talking about a government shutdown. Also, we hit the debt ceiling at about this time last year. Every time each of those events come up into the news, there's usually an eye towards the tax rates that we pay as Americans and corporations and investors to be able to give the money or the revenue to the federal government so they can pay those obligations. But there are solutions that help limit the amount that we pay. So again, with all of those things in view, it might be important to talk to the folks at Connective Federal Credit Union because we do feel that there is credibility to the argument. The tax rates, maybe not in this election cycle, but in subsequent years down the road, might actually increase to help cover the costs of everything that the government is spending money on right now. So just kind of an important reference point for you. Okay, rounding the bend, we've got this slide and then one more, and then Winston, I'll turn it over to questions if there are any. What's really interesting is the cost of CDs for clients that are sitting in a taxable account. I really think this is an important issue for many. You know, last year, a lot of us as Americans went to our local bank and credit union and opened up a CD. We hadn't seen CD rates on a 12-month CD at 5% in quite some time. Plus, it was a way to get a guaranteed yield and take some risk off the table at the same time. So it made a ton of sense. The problem, though, is that there's a couple of other elements that impact the value of that 5% yield. And if you look at kind of the teal color, last year, if you got a 5% CD, unfortunately, a lot of people forget that once that yield pays out, it's treated as ordinary income on your 1040. It's taxed at your marginal tax rate. So for higher income earning folks in the United States, the more money you make from an income perspective, the more you're taxed, and the less this 5% CD would yield on an after-tax basis. In addition, you don't get 5% just for showing up at the credit union. You got to wait until the maturity of the CD, which unfortunately means you also have an erosion of purchasing power because of inflation. So when we look at a 5% CD rate after taxes and after inflation, on a real rate of return perspective, you're losing about 1% effectively. So definitely an important issue. If you're seeing your CD mature right now, that might be another area to focus on with regards to a relationship with Connective Federal Credit Union as well. And by the way, there are some areas of the market that are yielding a little bit more. If you look at municipal bonds, they're currently yielding about, on average, about 4.2%. However, remember, the yield that's generated from municipal bonds is tax exempt at the federal level, which means we've got to look at the tax equivalent yield of munis, which are currently floating at about 7.25, as you can see here. So a little bit more value because of the tax treatment of munis relative to CDs. Okay, and then the last slide, gosh, there's so much here. I think this is such an interesting case study, and I'm going to grab my pen here just to highlight a couple things for you. The first is if we go back to 2022, so we go back to the very beginning of 2022, and let's say you had $10,000 to invest, and you put it in a balanced portfolio. By the end of that year, remember the S&P 500 alone was down about 18%. So your $10,000 investment, unfortunately, was now worth about $8,400. So let's say you call your financial advisor and ask, okay, what do we do at the beginning of last year, 2023? And your advisor says, well, look, you're in a good portfolio, buy plan design, again, that accommodates for moderate to severe instances of volatility. Let's just stay the course. Well, if you had made that decision and done nothing, your $8,400 would have rebounded to about $9,700. You hadn't quite recouped your original dollar, but you definitely recovered a lot of the wealth that you might have lost in 2022. Conversely, let's say you went with a more conservative portfolio or even a more aggressive portfolio. Maybe you felt that the market was on sale and it was a good time to lean in and take a little more risk. All of those decisions were rewarded relative to cash. And unfortunately, even with a 5.3% yield on cash, you didn't quite recover as well as you would have had you stayed put, taken less risk, or even more risk over cash. So the moral of the story here is oftentimes just simply sticking to the plan can provide a markedly better outcome if we give it a little patience. And I think that's a great lesson for all of us as investors as we enter an election year with a lot of headline risks ahead of us. And with that, Winston, I'll turn it back over to you.
All right, thank you so much, Chad. And also, this last slide is very, very good, especially with the market we just went through, the turmoil with the interest rate, although it was very great for everybody who loves CDs. But also going into the market this year. Want to open it up to any questions we may have from the attendees. If you want to put it in the chat box, or I believe you can raise your hand. But if you can, please put it in the chat box. We'll give you a second to do that.
Winston, if I may, while we're giving folks a chance to find the chat button, I should add one of our key expectations this year, as I referenced earlier, is around the Fed itself. And again, we have seen improvements to inflation. The jobs report continues to come in with some really strong numbers, which is great. Our current expectation, though, is it feels like things are appearing to kind of calm down a little bit, which means that it's taking pressure off of the Fed to either keep rates higher for longer or even increase rates. So our current expectation is based on the current data. We believe there's a 40% chance of a recession in the second half of the year. Keep in mind, our original probability in December last year was that we had a 55% probability of recession. So we definitely have some improvement there. And by the Fed's measurement, we would expect the Fed to potentially reduce rates by second half as well. So we're kind of talking about June or July timeframe.
Okay, yeah, I was going to ask you that. Like, what is kind of your outlook and feeling about the Fed reducing rates, so everybody can get prepared? It looks like we have one question from Lisa. I'll see if I can patch her in and allow her to talk and ask her question. So here you go, Lisa.
Hi, Lisa.
Lisa, can you hear us? Oh, maybe she wrote in the chat box. Hey, Lisa, you can also write your question down in the chat box. It should be at the bottom of your screen. But you are allowed to talk right now. All right. Looks like Lisa can't ask the question right this second. I have another question, Chad. So even with the election coming up, again, this election is like a very hot topic, just because of how polarizing it is. It seems a little bit different than some of the other elections we've had. But even with that coming at the end of this year, do you see that affecting how the Fed is moving right now as far as the rates, or do you think that's going to be totally separate if we do by chance have a change in the presidency?
Great question. Great question. So one of the important elements and roles that the Fed plays is to mitigate or manage our economy. And they largely do that through the reduction or increase of interest rates, either to heat up the economy to get things moving forward or to slow it down. One really important element about that relationship is the Fed normally tends to ignore politics. Although the president, of course, does suggest who should be the leader of the Fed itself. But that said, politics is largely outside of the role of the Fed. Their mandate is really twofold. It's to get jobs on the table and to make sure that they keep inflation under control. And it's really that second one that they are primarily concerned about. What's really interesting, too, I'll mention, Winston, is that the Fed historically has been much more communicative and consistent in its communication, which the markets really appreciate. Our markets don't particularly like uncertainty, and that's where we can tend to see a lot more volatility. So the Fed has been doing quite a good job with regards to just simply communicating its current stance and then acting on its promise when we see an FOMC meeting. But no, those two are kind of more separate issues. I will say from an election perspective, a lot of us really feel that an election is going to drive our market. And of course, as I'm sure you might imagine, Russell is a research firm first. We do a tremendous amount of data diving on this topic just to see, is there any evidence about who's in office and what direction that might have on the markets themselves. And not just from the White House's perspective. We look at different combinations of the Senate and the House of Representatives relative to the White House. So you can have obviously a Democratic president, and then both parts of the legislature led by the GOP and vice versa, or different combinations. What we found is it doesn't really seem to matter which combination is in office or in power for any given election cycle. The market simply just comes back to earnings and market share and projections and that sort of thing, which has been really positive. We saw a really good end to last year from an earnings perspective. Earnings on average were about 10% up to the good, and 70% of companies, at least as of last week, had reported earnings. So we're seeing a pretty positive number there alone, which is definitely good for our market. But elections don't really seem to impact it to the degree that we give it credit to.
All right. Well, I think that's good news too, and I think a lot of our members should have some outlook on that for sure, because that's something we're all looking at and thinking about going into the end of the year. Hi, Lisa, you have your hand raised. If you can type your question into the chat box. I don't know if we can allow you to talk based on how we have the webinar set up. Oh, we just lost Lisa. I'll reach out to her later. Well, in that case, I want to say thank you again, Chad, for sharing your knowledge and expertise, and of course, giving direct access to our members to ask questions. I know you're a great resource. I also want to thank everybody for attending.